Well, the markets have finally noticed that there's a big Fed speech coming. Big day of losses for Wall Street across all the major indexes today. US dollar coming up off the mat, yields coming up, bonds retreating, crude oil still doing what crude oil does. An interesting day in the markets to be sure, but of course, tomorrow beckons, and it is likely to be even more interesting as the thing that the markets were anticipating today actually occurs. We have, of course, that fateful speech from Fed Chair Powell at the Jackson Hole Symposium. This is Ilya Spivak, and I'm the head of global macro here at tastylive, and we are going to go through all of it here and consider what is it that the markets think that they are going to see, what is it that they don't want to see, what are they hoping for, and how that's likely to impact where we go from here. Needless to say, the big question is whether Powell will give investors what they want, and the price action today seemingly speaking to the idea that maybe there is a risk of disappointment. We take a look here at the way the markets stacked up, as we just mentioned at the top of the show. S&P 500 down about 0.75%. NASDAQ down 1.5%. Yields up across the curve, with the front end getting a little bit more of it. The 2-year up 2.26%, the 10-year up 1.6 almost. Crude oil finding a familiar bottom here and coming up, seemingly unrelated to anything that's going on elsewhere here. It's been bouncing around the range of about just under 80 to just where it finds itself today. So we get this bounce that seemingly keeps us within this kind of narrow digestion with 71 on the bottom and something like 78, 79 at the top. It doesn't seem to take its cues from what goes on elsewhere here, but then we pick right back up. The dollar up against the euro, up against the yen, and of course gold down as well to sort of round out the strong dollar, higher yields narrative as the impetus for what's going on here. So what did the markets get so spooked by, and why this stacking of the major assets? Well, we can see here from looking at the CME's handy FedWatch tool that the probability of a 50 basis point rate cut at the Fed's September meeting is actually down today. And we can see how it's evolved here. So if we look back a month ago or so, we can see that there is no conversation about a 50 basis point rate cut. In fact, there's a slight probability that the Fed actually keeps rates on hold in September, although by this point, the chance that some amount of rate hike or rate cut rather is obviously overwhelming, because we can see that the chance that it won't happen is very, very narrow. Overwhelmingly, with an over 80% chance a month ago, the market thinks there will be a single 25 basis point cut. The chance that there will be a 50 basis point cut is negligible, and in a sort of poetic way, smaller than the chance that there will be no cut at all. So the markets think there will be a cut, but if there's not, then it's likelier that the Fed holds than it gives us a jumbo-sized reduction. But then, of course, if we look a week back, the situation is quite different. Markets still lean by this point. This is after the volatility spike on August 5th. This is now the 15th. And here we can see still favoring one cut, but the likelihood of a 50 basis point cut now significantly higher. Yesterday, this calculus was meaningfully more in favor of a 50 basis point cut, almost 40% chance. And today we recede back to essentially where we were a week ago. And against that backdrop, as the likelihood of this jumbo-sized cut comes in by, let's call it over 10%, give or take, we end up with the response that we have today. And so it's not surprising that the front end sees more of an increase in yields, but yields rise overall. Stocks don't like it. They, of course, would like more easing, not less. Gold down, dollar up against the major currencies, risk off in crypto. So that seems to make sense. Now, what is actually the reason to be worried about this now? Well, we're going to get a speech tomorrow from Fed Chair Jerome Powell at the annual central bank symposium that the Fed hosts in Jackson Hole, Wyoming. And this is oftentimes a sort of lens-setting exercise where the Fed comes out and says, here is how we are thinking about policy. Broadly speaking, here's the thrust of how we are weighing up these variables for the next year. And the markets then can interpret incoming economic data and do their best to play armchair Fed chair and say, okay, well, here's the lens that Powell told us everybody is going to be looking at this through at the Fed. We adopt the same lens and try to figure out what the Fed is going to do as this news flow comes in. And against this backdrop, of course, it is very interesting to see whether Powell will tilt in this 50 basis point direction for September or tell everybody to cool their heels. Now, what's interesting in particular about all of this is the markets have, for months now, anticipated that the Fed is falling behind the curve on rate cuts. That essentially it is waiting too long and that it will need to ultimately have a period of catch-up rate cuts because it will have held its fire so long that it will have missed a turn in the economy, and then it will need to deliver more stimulus because it will have unduly weakened economic growth. We can see this happening as the Fed, toward the middle to end of the second quarter, starts to ever more loudly whine about inflation not going down as fast as they want. In May, they say there's been a lack of progress on disinflation. In June, they make that sentiment official and say, we told you in March we wanted to cut 3 times this year. That was our best guess. Same as what we told you in December of last year. Now we're going to have to cut that back. And now we're only anticipating 1 cut this year because inflation is not going down like we want. What was the response from markets? Okay, sure. You don't want to cut now. What this means isn't just that the rate cuts you intended for this year now have to migrate into next year. You're actually going to have to do even more cuts next year than just this. And the reason is you will have waited for too long. The economy will be ostensibly weaker than you wanted it. And now you're going to have to pile on stimulus to catch up. We see this here from about the middle of April or so. The outlook for where policy goes this year, the gray bars, is holding fairly steady at 1 cut with slight optionality for a second. Depending on when you look, it's hovering around a 50-50 chance of a second. Meanwhile, the tally for 2025 in the yellow here starts to balloon out. And stocks like it. They like it up until the beginning of July. Stocks say, oh, good, there will be more stimulus later. Now, why do the markets look at this and say this delay will mean this much more easing is going to happen? In fact, they almost double the amount on the menu. When we start this, it's 76 basis points through the end of 2025, 3 cuts through the end of next year. By the time we get to the end of June, it's almost double that at 133 basis points. And this part of the move hasn't even occurred. So, why is it that the markets think the Fed is falling behind? Well, since mid-April, shock of shocks, what we have is increasingly dire U.S. economic data flow as relative to expectations. Now, this doesn't mean that the data is wholly bad in absolute terms. It just means that whatever models economists had for anticipating a baseline of where U.S. economic growth is going, that model turned out to be more optimistic than reality endorsed on the whole. And so what you start seeing is economic data is deteriorating. First, it's weakening relative to forecasts, but still managing to beat a bit. It falls under this zero line on the Citi U.S. Economic Surprise Index somewhere around the early part of May, and essentially is saying then to markets, now the data flow isn't just less good. Now it's starting to pointedly underperform on average when U.S. data comes out. And the deterioration continues here going into July and August. And so as the markets get all of this data, they go, well, data's getting worse. Fed is getting resistant. That means that rate cuts will be late. They might miss the recessionary turn. That raises the risk of a recession and a more rapid rate cut cycle later. Now, the markets don't act on this with any kind of fear or trepidation until the beginning of July, when the Fed seems to acknowledge it. And this is an important caveat here, because July, and pointedly not the end, but the beginning, marks a key tone shift from the Fed. Powell comes out in testimony on July 9th and 10th and tells Congress, we are now getting concerned about growth. And the risks that we now overshoot on the unemployment rate are almost on par with the risk that we're going to overshoot on inflation. The response from markets is uncanny. Just as this happens, we get the top in the NASDAQ, we get the top in the S&P, we get the top in global markets. In the bottom panel here, in the green in particular, is the world stock index excluding the U.S. So we can see here that this is not just U.S. markets responding. This is a general sense in global markets that the price of the global currency of commerce, the U.S. dollar, is going to start to be cut. Normally, that would be good news in that it would be supportive of business, unless, of course, it is being done for the wrong reasons, unless the central bank seemingly validating and adding a sense of urgency to what the markets had been speculating on since July, that is, the Fed is falling behind the curve, that this news now says to markets, even they have now noticed something so intolerable that their tune has changed and they're prepared to pull the trigger. Lest we forget how much ink has spilled about chalking all of this up to the carry trade in Japan, let's just very quickly remind ourselves All of this happens well before the surprise Bank of Japan rate cut, and by the way, simultaneous Fed announcement on July the 31st, and the yen, as it normally tends to do, rises with a deterioration in stock markets. This is not anything to do with Japan other than, of course, an accelerant and a particularly pronounced symptom then shows up in Japan. But the issue clearly starts with the Fed signaling it is starting to see the weakness in the economy and is getting ready to do something about it, not at some point, but imminently. We get the distillation of all of this in the July Fed policy announcement, where we can very clearly see the Fed says job gains have moderated rather than remained strong, the message they had in June. We can see that the unemployment rate has moved up as opposed to remained low. We see that inflation has eased and remains somewhat elevated. That is less than just elevated. And perhaps this is here the punchline. The economic outlook is uncertain, but the committee now is attentive to both sides of its dual mandate rather than just attentive to inflation risks. We get confirmation of what hides behind this rhetoric just this week when we get minutes from this Fed meeting. And it becomes unmistakable that indeed the markets are right and the Fed is angling to cut in September. Risks to unemployment have increased, according to a majority of Fed officials. Many think that easing too late or too little could unduly weaken the economy, as opposed to only several still worried that cutting too soon or too much could risk letting inflation back out of the bag. And of course, the vast majority, this is very convincing language here, vast majority think it's likely to be appropriate to cut at the next meeting, which is September. So, not surprising that over the course of July, with the testimony and then the policy announcement, the markets say, right, there's a September cut. What's interesting here in particular is that in those very minutes, we get this tidbit here. Several, ostensibly dovish participants, thought that there was a plausible case for a 25 basis point cut in July. This is critical because at the time this meeting occurs, we have not seen the bloodbath that follows when U.S. jobs data underperforms on August 2nd, and we get that market meltdown going into Monday, August 5th. That data, ostensibly, starts the signal for the markets, hold on now. The Fed didn't just signal that they're ready to go. What they're witnessing is, in fact, the accumulated speculation that has already by this point existed in markets for 3 months, saying they've been late. And so the pain in the economy now is already intolerable in a way that they're going to have to do something outsized. So when you consider July and a Fed angling to cut, according to a vast majority of participants, quote unquote, when they give us that message, they've not seen this jobs report. They've not seen the level of market reaction to it. If some of them, or several, thought that even before seeing those things, it was already a plausible thing to cut in July, well, then ostensibly it's possible that by now, that several has become many or even most. And so it is not unusual then that the markets still hold out hope for this 50 basis point rate cut. We can see the likelihood of one is about 25% currently, whereas the likelihood of a regular sized 25 basis point cut is still favored with about a 75% chance. So there's seemingly still some of this on the menu. And if you consider what the Fed minutes say, given what's then happened between the meeting and now, you could envision that indeed a 50 basis point cut may now be consensus. And if ever there was a time to say that to markets, Jackson Hole is it. So the response from stocks in anticipation, not great, clearly, because what they want is the 50 basis point cut. Ostensibly, they've been seeing the Fed as late for quite a while, as we've just seen. And as the odds today came down a bit, the markets didn't like it. That some of this remains, however, suggests there's still room for disappointment. So if Powell were to come out and say something that the markets would then interpret as making a 50 basis point cut unlikely, you could see further downside. Ostensibly, the move is not over. Now, it seems like the message from the Fed chair is unlikely to radically change on the basis of one piece of economic data mainly. Sure, there's been more economic data, and some of it is disappointed, and some of it is surprised meaningfully to the upside, like the retail sales report. But one jobs report is really what much of this seems to be centered on. And Fed Chair Powell has said time and again that basing decisions on one data point or a small handful of data points is not how they like to do business. So while we're likely to get confirmation that we are looking at a rate cut, the text of the July policy statement and then the subsequent minutes seem to make that a foregone conclusion. One cut is coming. And from there, perhaps a message speaking to the recent volatility saying it would be premature to extrapolate from one report all manner of things. The Fed will be data dependent, of course, and react as needed. We still have another jobs report before the next FOMC meeting, after all. But that it is not going to commit to one thing or another at this point and remains mindful of inflation risks. That would be the kind of message that would essentially shift the spotlight to the next jobs report for signs of disappointment, while at the same time saying we're not committing to 50 basis points here. Which from the market's perspective, given that there's still a 25% chance that such a thing occurs, represents downside risk now that we've slipped back under the 5,600 level on the S&P, and leaves room for this market to continue to correct some amount lower. And of course, we'll see how far lower that might be if the likelihood that there's a 50 basis point cut is further diminished by what Powell says. And that is Macro Money for today. It is also the last episode for this week. We're here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. This show will, of course, be back to next week. I'll be on tomorrow, as I am every Friday, with Chris for Futures Power Hour, just after Powell speaks. So we'll unpack what the impact was. Make sure you tune in for that. I'll be back with Victor and Tom for First Call on Sunday. Again with Victor on Wednesday for The Price of Truth, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you for Macro Money next week and for Futures Power Hour tomorrow.